Every single year, millions of people proudly call themselves investors, yet the overwhelming majority of them lose money to the very market they believe they finally understand after years of study. The reason is not bad luck, not poor timing, and not a lack of discipline. The reason is that they are playing an entirely different game than the people who are actually and consistently winning. On the other side of your trade, there is almost never another retail investor making decisions the same way you are. There is a machine, a model, and a mathematician who has already built a detailed picture of how most market participants tend to behave. These professionals do not call themselves investors. They call themselves quants, and the difference between those two words is worth understanding more carefully than almost anything else you will ever learn about money. A traditional investor reads the earnings report, watches the news, studies the chart, and eventually makes a decision based on what feels like a reasonable conclusion about where a company is heading. A quant looks at the exact same situation and asks a completely different question. Not what will happen, but what is the mathematical probability distribution of all possible outcomes, weighted by historical data and current market conditions. That single shift in thinking from prediction to probability is the foundational difference that separates people who build wealth systematically from people who simply hope the market agrees with their opinion. Most people believe the stock market is a place where patient analysis of strong companies eventually gets rewarded with proportional and predictable returns over a long enough time horizon. What the market actually is, however, is a continuous real-time auction where every participant is simultaneously trying to take advantage of the informational and behavioral inefficiencies of every other participant without a single exception. When you buy a stock because you genuinely believe in the company, a quant on the other side has already modeled the statistical likelihood that someone with your behavioral profile will exit the position within a specific and predictable time window based on historical patterns. This is not a controversial idea. This is a discipline called behavioral finance, and it is one of the most well-documented and widely studied fields that explains why institutional players tend to achieve better outcomes than retail investors over time. The quant revolution did not begin on Wall Street. It began inside the physics and mathematics departments of universities, where brilliant researchers realized that financial markets follow patterns that can be described, modeled, and applied with surprising precision. In the 1970s, a mathematician named Jim Simons walked away from academia to build one of the most successful quantitative investment firms in history, and what he created there would permanently redefine what success in financial markets actually looks like. That firm did not hire economists, MBAs, or experienced Wall Street professionals. They recruited cryptographers, astronomers, computational linguists, and number theorists who had never touched finance in their entire careers. The flagship strategy of that firm generated some of the highest documented long-term returns in the history of institutional investing, maintained consistently across multiple decades with remarkable stability. No traditional investor in history, not the most celebrated value investors, not the most respected macro traders, has come anywhere close to matching that kind of long-term performance using fundamental analysis alone. The reason is not that Simons understood companies better than anyone else. The reason is that he was asking a fundamentally different question about what kind of information actually predicts price movement in real markets. Traditional investors search for value. They want to buy something worth $100 for $50 and wait patiently for the market to eventually recognize and correct that difference. Quants search for signal. They want to find any repeatable statistical pattern in price, volume, sentiment, satellite data, or alternative data sources that predicts the next move with even a small and consistent mathematical edge. Even a modest and consistent edge applied systematically across thousands of trades with disciplined position sizing and rigorous risk controls compounds into returns that seem remarkable to anyone still thinking like a traditional long-term investor. Here is something most retail investors never discover in their entire investing careers. The biggest risk in financial markets is not volatility, it is not drawdown, and it is not even being wrong about the direction of a position. The biggest risk is position sizing, and quants figured this out decades ago through a mathematical framework called the Kelly Criterion, which calculates the precise fraction of capital you should allocate to any trade based on your actual statistical edge. Most retail investors allocate too much capital when they feel confident and lose significantly, or allocate too little when uncertain and fail to compound meaningfully. This single behavioral inconsistency erodes more wealth than any individual poor stock pick ever could. Another concept that permanently separates quants from traditional investors is factor exposure. The mathematical decomposition of your portfolio returns into the specific and measurable risks that are actually driving your performance beneath the surface. When a traditional investor says their portfolio performed well last year, they typically mean it went up, but they have almost no idea how much came from broad market movement, momentum, sector rotation, or anything resembling genuine skill. A quant engineers a portfolio specifically designed to isolate and harvest particular risk premia while systematically reducing the exposures they are not being adequately compensated to carry, which is a fundamentally more precise and honest approach. You might be thinking right now that this sounds extremely complex, requires expensive infrastructure, and is completely inaccessible to anyone outside a major institution managing billions of dollars in capital. But here is what has changed dramatically in the last decade. The tools, data, and computing power that once required a very large institutional budget are now available to any individual with a laptop, a programming environment, and genuine curiosity. Various platforms and open-source backtesting frameworks have made it possible for individual researchers to build and deploy systematic strategies with the same mathematical rigor that elite investment firms once used exclusively. Alternative data, including satellite imagery of retail locations, aggregated transaction data, social media sentiment scoring, and global logistics tracking, is now commercially available to independent researchers at previously unthinkable price points. The transition from investor to quant does not require you to abandon fundamental research entirely. It requires you to express that research in a language the market can verify, replicate, and measure with actual statistical confidence over time. Instead of saying a company looks undervalued based on your reading of the balance sheet, you learn to say the price-to-book ratio for this sector has historically reverted to its mean within 90 trading days under these specific macroeconomic conditions with measurable consistency. That is not simply a more sophisticated way of expressing the same belief. It is an entirely different intellectual framework that forces radical honesty about whether your edge is real or merely a story you are telling yourself. The market does not reward conviction, does not reward hard work, and does not reward emotional loyalty to a thesis you spent months developing. It rewards edges that are genuine, systematic, and tested against the full weight of historical evidence. The only question worth asking before your next trade is not whether you believe in what you are buying. It is whether you have actually proven with real data that your belief has ever been statistically worth anything.